let's get into the micros. Jignanshu Gaur joining us, Director and Senior Research Analyst at Bernstein, India. Very good morning, Jignanshu. Let me first start off with the big picture. You've maintained that target price on Trent. You've maintained the ratings. What is it that will be the early indicators to determine that there is going to be a change both on the target price as well as on the rating? Let's start with that. Of course, growth will likely be, but what will the early indicators be in terms of judging whether growth is coming back or not?
So thank you so much, Harsh, for having me here. Always a pleasure, first of all.
Thank you.
You are absolutely right. I think the one currency that most consumer companies in India trade on is growth. Trent has stabilized its growth slide over the last 4 quarters. It's been in the 16 to 19% kind of a range. It needs to jump up beyond 20%. So while growth, yes, but I think the barrier that most people are thinking about and what we feel is where which can give a impetus to the stock price from here should be growth above 20% and a healthy like for like growth of high single digits. Those are the two early indicators to ensure that the growth rate is sustainable.
Jignanshu, hi, morning. So I want to talk about Zudio first because I'm just looking at the same-store sales growth and that's running now into low single digits. It's trailing value retail players as well. How concerned are you about this like-for-like momentum for Zudio versus growth that's purely being driven now by new store additions?
So frankly, we don't know whether the like-to-like mid-single-digit growth or low-single-digit growth is for Zudio, Westside, or is it a combination? Because the definition has generally been put together. Our checks indicate that, in fact, Westside seems to be doing slightly better than Zudio in the last 2 quarters or so, which translates to better gross margins for the company as well. But that's where the concern is that Zudio's, while it has been steady, the revenue growth and the profile, they have not really fired up in the last 2 to 3 quarters. Maybe the entire base effect that they had of the extremely fast growth which the company observed, that hasn't really gone away yet. And that remains a concern, but limited information from the company makes it difficult to make it a definitive judgment.
Jignanshu, hi, morning, Sajith here. Couple of things. One, is it fair to now assume a medium-term growth rate of 16 to 19% for Trent? And second, since the expansion of Westside is very slow as compared to Zudio, the high-margin business will not be there. And if Zudio is expanding into tier 2, tier 3, is competing with the value retailers there. So the volume growth would be a little compressed.
So yes, I think Westside store on a percentage basis, they are actually adding more Westsides than they were adding in the past, materially higher. They are adding 50 Westsides, or last year they added 50 on a base of 250, which was 20 odd percent Westside store growth. More importantly, like I said, our channel checks indicate that Westside stores are probably doing better on LFL than Zudio. So in the near term, the share of Westside seems to be higher or increasing faster than the share of Zudio, which is giving better margin profile. However, if we look 1 or 2 years ahead, as you very rightly put, uh, there is a limit to how much the gross margins can be stretched. We think they are at their peak. Operating leverage will take time to come. The two big sources of operating leverage, employee and rental. Employee, I think it's played out. The whole implementation of RFID as the first company in India to do in all the retail stores, that has played out. Rental will need LFL to come back. So yeah, we think margins are peaked here. Any further margin needs better LFL and hence operating leverage. Without that, the margin surprises which we are seeing in the last 2 to 3 quarters might be challenging to repeat.
And what about Zudio, competition of Zudio to value retailers in tier 2 and tier 3 cities? Do you think that's going to be a little challenge given the fact the ticket sizes are much lower for the value retailers as compared to Zudio?
See, I think I'm not too concerned about that because even in urban areas, there was a competition to Zudio, which was a lot of other fast fashion organized or unorganized players. In our discussions with both customers as well as supply chain players, there is a difference in proposition of Zudio versus the other value retail players. They are not necessarily thought of in the same bracket. So we think that is not a concern. And in fact, we have seen enough examples where both or multiple value retail players, which are the listed ones, exist alongside Zudio. And Zudio has been able to ramp up their their revenue reasonably fast. So that I don't think that's a concern. The issue probably is that in smaller towns, what the kind of merchandise that Zudio sells, their maturity profile of the stores will be slower than the maturity profile that they saw in the top cities, which means your revenue per store ramp up will be slower, and your eventual revenue per store also might be slower, though your margin profile in percentage terms might be similar.
Jignanshu, last off, you spoke about how there's a twin engine on margins, right? One is, of course, stores and the rental. The other one is employee costs. You're saying employee costs will largely now start to stabilize. But you still have one engine which can still continue to give you margin upside. Why then are you saying margins have peaked near term?
Because the gross margins are seeming too high right now. So as Sajid mentioned, I think over time, as the Zudio store addition continues to be higher than Westside, the gross margins at 46+%, we think are not sustainable. We think the sustainable gross margin is 100 to 150 bips lower than that. And hence, any operating leverage from rental will be crossed out by that.
So why still stay outperform then on a trend, Jignanshu?
Because it remains it's a compounding story. While we don't see the inflection point in very short term, it's a great execution machine in the right market, growing reasonably fast. In most players, we would kill for a 20% growth rate and 25-26% EPS growth. It's just and hence we remain positive with a 12 to 13% upside on the stock over the next 12 months because we think it's a compounder, but don't see an inflection point in the near term, which is why we don't increase our target price.
Understood. Okay, Jignanshu, always great chatting with you. Thank you for your time.
Thank you. Thank you so much.